All right, today we are pulling back the curtain on the market. We're going to look past those simple, squiggly line charts that everyone else is staring at and see the hidden structure that most traders completely miss. And it all starts by asking a really basic question. What does a market actually look like? Seriously, if you strip away all the headlines, all the noise, what is its real shape? What is it trying to do? Because most of us, we think we know. We have this one image burned into our minds. We see a line chart, right? Just a simple path that zigzags up and down. But you know what? Looking at that is like trying to understand a city just by looking at its skyline. It's flat, it's incomplete, and honestly, it can be dangerously misleading. And that leads to this classic frustrating problem, which market analyst James Dalton just nailed. You can do all your homework, you can know a company inside and out, and still have no clue why the stock is doing what it's doing. That tells you, right there, that a huge piece of the puzzle is missing. Okay, so let's get into it. The missing piece is this. The market isn't a line. It's a giant, continuous, two-way auction. It's all about human beings, buyers and sellers trying to find a price they can both agree on. And you know what? It works just like any other auction you've ever seen. Let me give you a super simple example. Imagine a GM dealer gets a shipment of 50 new cars, but they only sell 34 of them. What happens? Well, now their lot is packed. They've got too much inventory, so they have to start offering discounts. The price auction's down until enough buyers come in and say, okay, at that price, I'm interested. The stock market is doing that exact same thing, just a billion times faster. And the whole point of this constant back and forth, this auction, is to discover something called fair value. It's just the price or range of prices where the most people are willing to do business. It's where buyers and sellers agree the most. Think of it as the market's center of gravity. So, if the market is an auction, how in the world do you actually see it? How do you figure out its shape and find that fair value? Well, that is where this tool, the market profile, comes in. It's like putting on a new pair of glasses that lets you see the auction as it's happening. And this right here, this is the fundamental shift. Looking at price alone is just looking at a number. It means nothing. But the market profile puts that number in context. It adds two other crucial ingredients: how much time the market spent at a price and how much volume was traded there. You put those three things together and suddenly the market's real structure just pops into view. And this is what it looks like. See that classic bell shape? That is a market that's found its balance. You've got price running up the side, vertically. Each letter represents a different period of time during the day. And the overall width, the shape of the whole thing, that shows you where the action was. That big bulge in the middle, that's the sweet spot. Now, that big bulge in the middle has a specific name. It's called the value area. This is the zone where about 70% of all the trading for the day happened. It's the market saying, yep, this is a fair price. Anything way above or way below this area is considered an extreme, either a potential bargain or way too expensive. Okay, so understanding the shake is one thing, but to really get what's going on, you also have to know who is creating that shape. You got to meet the players, because not everyone in the market is there for the same reason. On one side, you have the day trader. They're in and out in a flash, reacting to every little bit of news, and they provide a ton of liquidity to the market. But on the other side, you've got the long-term investor. These folks are holding on for months, maybe years. They care about fundamentals, and they're the ones who really start the massive, long-lasting trends. And here's the kicker. It's the constant battle between these different players, the short-term guy versus the long-term guy. Their totally conflicting goals are the engine that drives this whole auction forward. So why does any of this matter? What's the payoff? Well, when you can see the auction and you understand who's playing, you can start to spot what is, for my money, the holy grail of trading, the asymmetric opportunity. So what is an asymmetric opportunity? It's really simple. It's a bet where your potential reward is massive and your potential risk is tiny and well-defined. You're finding situations where the odds are just stacked overwhelmingly in your favor. Let's look at a real-world example, because this is where it gets fun. This is gold back in early 2006. Look at how it just goes vertical. There's no pausing, no building out those nice balanced bell-shaped curves. This isn't a market building value. It's a runaway train driven by pure speculation, and that makes it incredibly fragile. And here is the smoking gun. On the exact day that gold hit its highest price, the trading volume was less than 99,000 contracts. That was way, way below average. That is a massive red flag. It's the market telling you that the auction to the upside is exhausted. The buyers are gone. The best way to think about it is like a high-end art auction. The bidding is frantic, paddles are flying up, the price is soaring, and then boom, silence. The room goes quiet. Nobody is willing to bid $1 higher. That's exactly what happened in the gold market here. Price got pushed to an extreme, and the buyers just vanished. And for a trader who sees that, that is a gigantic asymmetric opportunity. And this really is the key takeaway. Seeing the market this way lets you spot these changes, these shifts in structure, before they're obvious to everyone else. Because once the change is on the front page of the newspaper, the big money has already been made, the opportunity is gone. So let's just recap this new framework. First, you've got to see the auction, not just the squiggly line. Second, you use the profile to pinpoint the value area. Third, you have to understand who the players are and what they want. Fourth, you look for those moments of imbalance, when the price gets way out of whack. And fifth, that's where you find your asymmetric edge. And that leaves us with one final thought to chew on. We've just seen that financial markets have this hidden logical shape underneath all the chaos. It kind of makes you wonder, what other complex things in our world, from social media trends to climate data, have a hidden shape that we're just not seeing yet?